want to make sure that we have everybody on. I have a new computer system and everything set up. So Paul, raise your hand. Can you see me? All right. Hi, Paul. Thanks. Today's class is chapter or class 5. We're going to start on page 180. And then the next class is the final class. And that will go from there. I'm sorry, next week we'll start at 180 and then be the final part of the book. You'll have time to look through the pages to catch up on anything. For those of you that attend the next course, we're going to follow the same outline, but no one class is the same because we can look at different items throughout the outline differently. I keep referring to beta. Well, there's different ways of looking at beta, different angles, different ways of determining what that means. So there's a lot of information here. I tend to talk too fast for a lot of people that aren't really into this as much, but I think if you flip through the book on the pages that we're covering, and as well, if you go back and watch this again, we've got 2 of the classes on the website now that you can watch again if you'd like, but it's like a foreign language. If I were traveling to France and I started taking French lessons, it's just no way I'm going to learn the full language. And the more often that I can be exposed to it, the better. So anyway, I'm going to share our first program here. Let's see where we have share. Oh, here we go. Okay. Hopefully we can see the Friday forum slide. Talks about March 11th. Stan Forbes redistricting 2020. So take a look at that for a moment or two, and then I'll bring that down and start the slides. Okay, we should be able to see the first slide of active retirement investing. And again, if you haven't ordered this book, order the physical copy if you need to write in it and highlight it or just download it. Marcia has sent that to you if you wanted that, or if you want either of these, or if you want anyone else to have the copy of this book. Active retirement investing is the outline for the class, of course. And as you'll recall, it covers 3 stages or sections. Section 1 is about financial planning, which we touch on lightly, but we don't have time to talk about it. And that's the cash flow, insurance, taxes, estate planning, and old investments. Section 2 looks at current investments, and we've talked about exchange traded mutual funds. The benefits are that they're publicly traded throughout the day, good or bad, depending on the timing. But you have many more choices of exchange traded mutual funds. That's the way of the future for the mutual fund companies. It's easier, faster, and cheaper for them to create an exchange traded mutual fund and then push it out into the sea by itself to be traded among investors and market makers and authorized participants. That takes a lot of the work off the back of the mutual fund issuer who wants to create a mutual fund and manage it. And then, as you recall, there's different types of exchange traded mutual funds and old mutual funds. The index funds buy one of everything, and the Dow, the S&P, the total market index, they pay a fee to follow an S&P 500 recipe, let's say, and then they can create their own fund. The reason that companies create these funds is they want the management fee. A very large index fund is huge, billions of dollars, so they can bring the fee down really low. Problem with just following the index is you're down 12% today from the total market stock market index. So then we go beyond the index fund into some passively managed or allocated exchange traded mutual funds that might have a mixture of bond index and stock index funds, and they might be down, let's say, half as much as the overall stock market because it padded the portfolio with some less volatile investments. And then we talked a little bit about some of these exchange traded mutual funds aren't necessarily indexed. They could be passively indexed with several different indexes in it. And then there are some exchange traded mutual funds that are actually aggressively managed, buy, sell, buy, sell. But you're going to see the old mutual funds converting to the exchange traded mutual funds because they're going to lose business if they don't. And some of the old mutual funds that you have hanging around outside of your retirement plan, if you sold them or exchanged them, there might be a huge tax hit. Well, look at that company's website and see if they're allowing people to convert your old managed mutual fund to their new exchange traded fund that's exactly the same without causing you tax liability. That'd be nice. You'd be in the new exchange traded mutual fund, same thing as you had before, but you can buy and sell throughout the day. They're more tax efficient, but if they'll exchange the old shares for the new shares, and I'm not saying everyone will, but if you're with a company that will, that would be really cool. You would avoid the taxes and then be in the same fund, but possibly one that has lower expense ratio and more tax efficiency. That tax efficiency means they're not buying and selling and triggering taxes for you. So some of the things that we need to consider. Let's take a look at the beginning of the class here. This is phase 2 of the portfolio construction. We talked about section 1 was financial planning. Section 2 and phase 2 is about creating a portfolio with those new exchange traded funds I just mentioned. And then the other part of the book, the last one, is the monitoring part. We'll get a little bit into that and more into the next and final class. So creating an actual portfolio. So let's say you have your old mutual funds in your non-retirement portfolio. It's in your name as an individual, or it's in a joint tenancy with your partner or spouse, which isn't the best tax efficient way to do it. If you are married, it's better to be in community property or in the name of your trust. So if one of you died, both halves of the estate would be brought up to full value, no taxes. It's called step up in basis. That's another part of the financial and estate planning process. But here we're looking at, how do I create a portfolio that matches my need? Because if you went and had just bought the S&P 500 index, or the S&P 500 index with several different companies, Schwab, Fidelity, Vanguard, iShares, just so all your eggs aren't with that one company in case they get hacked or COVID breaks out in their home office, you're still not diversified in the overall market. You're just in an S&P 500 fund with different carriers. That's fine. But what if that S&P drops? It's down like what, 10 or 11%. Broad market's down 12 as of yesterday. Maybe we need to diversify a little bit more. So buying just an index fund isn't always going to help us. So we need to look at, let's create a portfolio with several different exchange traded mutual funds in it. Exchange traded meaning they're traded in and out if you want. They're tax efficient for the most part. The IRAs, yes, also use exchange traded mutual funds, but you can buy and sell inside of a rollover IRA, TSA, tax sheltered annuity, or any other retirement plan and not have taxes until you pull the money out. So the exchange traded mutual funds tax efficiency isn't a big deal for a retirement plan, but it is very much for a non-retirement plan that you own as a sole person. Joint tenancy, not the greatest. Community property, better. And if you have a trust, the best for the most part. And those of you that do a living trust, all that is a giant beneficiary provision. A living trust, unless it's irrevocable, does not protect the assets from lawsuits and doesn't do anything for you tax-wise. But it allows you to know what's going to happen at your death. Vertical integration, bottom-up planning. Now, remember before I went on and on and on about having a portfolio or 3 different portfolios represent short-term investments that you could liquidate if the market crashes, intermediate term investments that you could liquidate if the market crashes, but with modest losses, and then long-term investments that you ought not liquidate and choose to hold for the long term. Now, when I say liquidate, any of those 3 stages, you can cash out in your brokerage account and turn it to cash within a day or so. If it's an exchange traded mutual fund or a stock, it could be, you could convert it to cash within minutes or an hour or so. So we want to have the thought that we have short-term, intermediate, long-term investments, but it doesn't mean you can't get out of the long-term. you ought not get out. So if you have a long-term growth fund that you bought recently, you're down 15%. Well, it's not the fund's fault. Don't cash out at a loss. That should be in your long-term bucket. So when you look at a portfolio, some of the investments represent very short term, some represent intermediate term, some represent long term. The short term will give you stability when you need to liquidate it. The long term will give you stability with inflation. Now remember, long-term growth stocks are designed for long-term results. Large company blue chip stocks, value stocks are designed more for short-term dividend results. We want the income now. So if you're buying long-term growth stocks or growth funds and you notice they're down a lot today because they hold a lot of technology, that technology is designed to give dividend returns 5, 10, 15 years from now. When the Fed raises interest rates, some people get discouraged saying, I'm not going to wait for this technology stuff. I'm going to go buy some CDs at higher dividend rates and I'm out of here. Or if you have a concern about a conflict globally, that is a worry that there's going to be a breakup in the short term to intermediate term supply chain and market. So people want out of the market. But in my opinion, a biggest part of the decline in the market today is the algorithms and the automatic transitioning into cash when the market starts to fall. If you have an algorithm that says cash out or a stop loss and a limit and all that kind of stuff, when the market falls, they trigger, and then that causes more panic and more fear. So when we talk about a portfolio today, every person has a different need for that portfolio, or you can break it into 3 different portfolios. But your need is different than your friend or your neighbor's. But we'll give you some basic ideas of plan from the bottom up. We know short-term, intermediate, long-term. We've had that discussion. Now let's look at thinking of a pyramid and looking from the bottom up. What does that look like? Well, here's just a generic picture of a pyramid, but imagine that there's 3 horizontal layers, and they're all equal in height. But obviously the bottom line is going to take up a big piece of this pyramid. That's the foundation. And this is where we encourage you to look at the largest bulk of your portfolio invested in large broad market index funds. That'll bring the expense ratio of the overall portfolio way down. And in the bottom part of the pyramid, let's say you have a balanced portfolio, half of it might be in a mixture of total market index funds, broad market index funds, pretty much the same thing. You look in the portfolio and it has like 2,000 stocks in it. And all the big names have their own broad market, total market, whatever. But in that, thousands of stocks in it, 2,000, 2,500, and billions of dollars invested because the Vanguards, the Schwab, the Fidelities of the world have brought a lot of money to that table. They've done everything they can to bring the cost of the fund down. In the old days, your expense ratio might be 0.25. Now we're looking at 0.015, 0.02 on a couple of them out there. I'm not going to say the name because I'll get in trouble for endorsing it. You have to do your homework. But there is one. It's a mutual fund, index fund with a big carrier. It's 0.015. It's not an ETF. But then the other competitor's ETF is 0.02 total market stock index fund. That's pretty cheap. Then on the other half of that bottom layer might be total market bond index, but we're concerned about interest rates continuing to rise. That causes bonds to be less attractive that are locked in. So it may be that total market bond index might be replaced with a short-term investment index in bonds. So short-term bond index, but a large one or several of them, so we can get as many different bonds in that portfolio, but still we want low-cost index funds. So the bottom part of the pyramid, the foundation, very large total market index funds. All the stocks in the market just dropped into an index. All the short-term bonds in the market dropped into an index, and then maybe have a few different funds with different companies just in case. When you own a Charles Schwab brokerage account, or a National Financial, which is the one I use through Fidelity for independent advisors, they hold the electronic information about where the money's held at these different exchange traded mutual funds, old mutual funds, whatnot. They're insured for cybersecurity to make sure that you're safe with them, and that if something happens, It's on them. They need to be responsible. They do not guarantee the performance of anything. You can still lose a lot of money, but at least in your basket at Schwab, TD Ameritrade, National Financial, Fidelity, you have the ability to diversify. So the bottom part of this pyramid, even if you want to have half of it in the total stock market index, I'd still recommend 2 or 3 different companies' total stock market index for the reasons I mentioned. Stage or layer 2, coming up the pyramid, a smaller group, would be specialized index funds that allow you to mix up a variety of indexes. So one might be a multiple index fund, might have a 4th in small company stocks, small caps, index, blend, growth and value. So small company stocks, they might have 25% invested in mid-cap company stocks. They might have some in large cap. So we have small, mid, large, and then they might have some in international or global. Well, that's not going to be as broad as the base down here, and the cost is not going to be 0.02 or 0.05 or 0.08. It's going to cost you more like 0.1 or 0.15 up, depending on how specialized they are. Why? Because that recipe and that theme is not as popular, so they're not going to raise as much money usually. And therefore, they have to bring the cost of running the fund, the percentage to you, up from 0.05 to 0.15, 0.25 to pay their bills. I'm told that most exchange traded funds, you can barely survive if you have $100 million. So if you're sponsored by a big company, sure, they'll help you. But if you've got a small exchange traded mutual fund that doesn't raise more than 100 million, it's going to be difficult to stay in business because of all of the people they have to have working for it. Second layer, more specialized exchange traded mutual funds. Also sector exchange traded mutual funds. I'll show you a list of this in a moment. That might be utilities, might be technology, might be energy, might be real estate at that point. So that's the middle part of the pyramid. More specialized index funds. They're not broad market, they're not as big, and the expense ratios are slightly more, but we're getting something more of what we want. If you had money in a utility stock, specialty fund, sector fund in the middle part of the pyramid, you're doing okay. You're kind of maybe flat right now, but you're not down 12%. So that paid off. Those of you that were willing to do energy, obviously those are through the roof. Some people will use energy funds to be a small percentage of the portfolio to take the edge off when the market falls. But those of us that were following just tech stocks all these years, you may have made a lot of money, but now there's a correction. And is it time to get back into tech stocks and growth stocks? Well, it's definitely a good time relative to the last year, but will it fall further? I don't know. There's, in my opinion, more than 100 million traders that make decisions every day, and we'll see what news causes them to move one way or not. I'm watching the market now, and it's turns into the red, and then it goes green, then it goes red. Interesting. Okay, so let's go into the next layer is the top of the pyramid. That's going to be a small group and a small pyramid in and of itself of managed funds. The baseline were obviously index non-managed. The middle part were passively managed, put together blocks, strategically allocated, and maybe rebalanced once a year. But the top part of the pyramid is a handful of funds that are absolutely managed. Now, one, for example, if you love Bitcoin, I see there's like half the people can't stand it and think it's a ripoff. The other half are passionately driven to Bitcoin. There are no exchange traded mutual funds that directly hold Bitcoin yet. The SEC has yet to determine that we can do that. But when they do, and of course the prices will move up quickly, I'd rather have an exchange traded mutual fund with a manager choosing which ones to get. I don't have a clue. Everybody loves Bitcoin. Obviously, it's extremely high price, but what other types of digital currency would be good for that fund? I would be doing a managed exchange traded fund, let somebody else deal with all the risk. And then someday when there's tons of them out there and it's they're more like a utility company, then I'll buy an index fund, get a low expense ratio. But the expense of a fund, if it's higher, should be worth what you're getting. If it's not, get the heck out, check your accountant, check with your accountant, make sure you're not going to get hammered with taxes. And then if you were, if it's a non-retirement account, call the company and say, what are the chances of me converting this to one of your ETFs? It has to be very similar, almost exactly the same. Level one, the base, we talked about low cost index funds, total market index funds. Then level two, we talked about index funds that mirror specialized indexes like utilities and things that we mentioned. More specific indexes and categories referred to sectors. So there are some areas that are called sectors that are specialized. You've seen the ad, Spiders, right? That's State Street Investment Company, and they abbreviate SPDR and they call themselves Spiders. One of the big selling points is they'll show that pie chart and they show that you can buy any one specific sector of the economy through them, and they'll have an exchange traded fund that represents the individual sectors. And of course, you can buy the total market and the S&P. But if you like one part of the economy, you can load up on it with an index sector fund that is much lower cost and buys only that sector, and let you balance your portfolio or be a hedge investor right now. And today, you would be hedging and also be a contrarian if you were to say, I'm going into high tech and all technology funds, which the NASDAQ, which represents most of them, is down about 20%. So that would be a contrarian buy. The problem is we don't know where the bottom is. And so maybe you buy a little bit today and a little bit a month from now, but that's the area and the sector that's down the most. The one that's up the most is energy. And of course, even if you didn't have a problem with that, you wouldn't buy something that's way overpriced, because a year from now, it could come crashing down if things stabilize. So the sectors are great, but they're primarily good to hedge what your total market index funds are and your other managed funds. Level three, as we mentioned, is a well-managed mutual funds. They offer defensive management techniques. So if they're in, let's say, I have one that I like that manages preferred stocks. Preferred stocks are stocks where the owners of those stocks get most of the big earnings and dividend from the company. The growth stock investors get more of the capital gains. So the preferred stock investor right now is probably earning about 5.5% yield. Wow, that's good. I'm just going to move everything over there and go for the yield. However, a preferred stock never matures like bonds. So you can't say, well, if I own this 5-year bond and I'm getting 3 and now new ones are paying 4, I'll just wait 5 years, cash out and do a new one. The preferred stocks never have that maturity date. So if you buy in now and you're earning 5 and rates go up and new ones come out paying 7, well, you're stuck earning that 5. And if you want to look and see what it would sell for in the market, you'll be disappointed that the price could be down. Dividend paying stocks are very vulnerable to rising interest rates. And in a normal world, they should be the ones dropping and the tech stocks should be going up. But there's a variety of other reasons that there's a lot of upset in the market. So investors are hanging on to the dividend paying stocks, even though the Fed says that they're going to raise interest rates. It's a huge drama and a huge soap opera, but we only know this until after the fact. If I'm an economist, I'm the smartest person in the room on Monday morning. I don't know what, and I can't guarantee what's going to happen in the future. I can just tell you what happened and why it occurred. What's going to happen in the future depends on those 100 million traders the next day, on how they react to news in the market. And we don't know how that's going to go. And plus you have all the machine trading and algorithms that are determining what a market does. Level 2, level 3, well-managed defensive measures. That preferred stock fund that I mentioned, my clients are paying 0.80 management expense. Oh my gosh. But when the index was down recently, I looked at it, it was down like 6.5. This fund was down like 4.5. So that's a huge benefit, and it makes the management fee a little more worthwhile. This fund will manage the preferred stocks very aggressively and also buys derivatives to try to reduce the downside. But it does cause the expense ratio to be astronomically high. Whereas if I was going to buy the same preferred stock fund as an exchange traded fund that was an index and preferred stocks, the one that was down 6+, its expense ratio would only be 0.20 or so, a fourth of the higher cost managed fund. Now, not all managed funds give you value in their expense ratio, and I would have to agree that most don't. And if I could put you in that time capsule and wake up in 50 years, all index funds would be the way to go, because you have plenty of time for the markets to adjust and them to invest their dividend. But because we may need some of this money in the shorter term, we need to have some managed funds if it's in an area that is of a high risk. Junk bonds, managed funds. Preferred stock funds, because they're high risk if interest rates go up, managed funds. Although if there is an index fund that or a passive index that does something to protect us, I'd like it, but I haven't seen it. So when you're wanting something more than just buy one thing and put it on the shelf, you're going to need somebody to take care of it and have passive management at least, or aggressive management. Best performing managed funds might charge lower fees than most managed funds simply because they got really big. So you can get a good managed fund that's quite large, reduces expenses, but there's always a flip side. What if they get too big and they can't move money around? Yeah, they're low expense ratio, they have a good track record, but they're so big that it's going to be hard for them to get me out of stuff that the market gets a little dicey. So that's one argument. So bottom part of the pyramid, one of everything. They're not responsible for buying and selling and get you in or out. So they can keep the expense ratio quite low. But when you get into the top part of the pyramid with managed funds, then we want to see some results. It's a little different for them. They have a lot of pressure on themselves. Examples of these, as I mentioned, bond funds, especially junk bonds. We don't want to own a junk bond fund and then find out some of the bonds and the companies that issued those bonds are filing bankruptcy or running into problems. A junk bond fund manager, I'm hoping, can get rid of those bonds because they track those bonds and the credit rating and the cash flow and the results of the companies that issued them every day. So my hope is they'll sell the ones that they're concerned about and buy new ones. I don't have to worry about that because I would never know. A high yield junk bond fund index, they're just going to hold them until some of them lose value. Now, if it's 2,000 junk bonds, there may be so few that file bankruptcy, it doesn't bother me. So I'll let you decide which you prefer, but I'd prefer any real junk bonds be managed at this point. Preferred stocks, I mentioned. Emerging markets, just before this Ukrainian thing, emerging markets were starting to look good. A lot of analysts said, you got to put money into emerging markets. International is the way to go, just before this thing. And I've never been heavily invested in either of those for my clients, but I'm thinking I need to start moving in that direction because the US stocks are overpriced, let's say. Some people believe that if you're paying 27 times the dividend, that's way overpriced, where maybe you could go to Europe and pay 20 times the dividend or less. But now we see that Europe is not as stable and as safe as the US, and you're going to have some volatility. So emerging markets, there's always the opposite to say that as well. Another view, though, is if they've fallen, which they have somewhat, and the international markets in Europe have fallen, I think, more than the US. The opposite side is, oh, good, I'm glad I didn't buy any, but is it time to start looking at that more aggressively? But now we have to start assuming we know how this conflict is going to end up. And as we know, it could go either way. So those are some of the concepts: baseline, no management; mid of the pyramid, passive management and allocation; top of the pyramid, very heavily managed. And if you believe in one area of the economy and that it's a little dicey, you could either buy that index as a sector index or buy a manager and hope that they can take care of you. You can look up when that manager started with the company. Past results are no indication of future performance for sure, but you can get some idea of how that manager and that fund has performed relative to adverse markets. And every market is adverse in its own way. I like low volatility exchange traded mutual funds. Oh, that's great. Oh, I especially like the low volatility high dividend exchange traded funds. And there's some called low volatility high dividend S&P 500 exchange traded funds. Yeah, it's got the word S&P 500 in it. That makes me feel like, wow, I'm going to get best of all worlds. Well, that's a great fund. But what it does is seek out some of the old over-the-hill staunchy stocks that aren't going anywhere. They're going to go up with inflation, maybe Verizon, AT&T, and Procter & Gamble and companies like that. But they'll also look at companies that have big dividends like that, and that would be energy and real estate and utilities. So before the crash in 2020, they were doing pretty good, had high dividends, people would buy them. When 2020 crashed and we thought that there was a global stoppage of work, that would be like you just bought a herd of dairy cattle and they got an illness that causes them never to produce milk. All of a sudden your cows are worthless. What are we going to do? So before the market crashed, low volatility, high dividend exchange traded funds were good because they had a high dividend. But when it crashed and the world thought that those companies that paid very generous dividends would stop, the low volatility, high dividend fund compared to the S&P dropped even more, probably dropped 39% when the S&P was down 35. How is that possible? Well, like I said, if you bought a herd of dairy cows and now they can't produce milk, what's the point? But right after that, the market started to recover. We realized that these companies weren't going to stop paying a dividend. Most of them didn't drop their dividends. So then I had clients buying in, not all, but some buying in at the bottom of the market, not because I knew it was going to recover, but that even if the dividends drop, they're still substantially higher than the other stock dividends because the stock price is low. How does that work? If you have a stock selling for $100 and it pays $5 a year, that's a 5% yield. That's huge. That's a lot. If that stock drops to $50 and they don't change the dividend, they keep paying 5%, then if the new buyer's getting a dividend that's equal to 10. So at that time, when the market fell, it was a good idea to move into stocks that had a big dividend, because if they never recovered in price, we got a relative dividend at a much higher yield and a lower price. Just saying, you'll never know exactly what to do ahead of time. That would be like going into a poker game, and if you could read everybody's mind, sure, that's great. You won this game and took all the money, but no one would come back to it. So you're always going to have volatility in the markets. I've been watching this stuff for 42 years. Some of you have watched it longer than I have. As soon as we think the market's going to go left, it goes right, and vice versa. Even if the Fed raises interest rates in a few months, slightly, junk bond funds might bounce back in value because we think we're controlling the economy and things are going to look better. Maybe interest rates have to go up because the economy is too hot. So who knows? Other things. Next slide. Our takeaway on this part is creating your ultimate portfolio that requires diversification, especially among funds and also among companies. We've mentioned why. Taking diversification further, lateral and vertical integration we've talked about. So let's look at some rules-based investing. You know all the basics about exchange-traded mutual funds. You know that you want to create a pyramid concept to bring the cost down as much as possible and increase diversification with a base in the middle part for all the reasons we mentioned and the top part. Now, how do we do this specifically? Well, I would use 10 to 20 different funds if you have a fair amount of money you're investing, 200,000, 300,000 or so. You would utilize a brokerage account with one of the companies I mentioned. You would do it on your own, or if you have an advisor, he or she would utilize them. He or she would have limited discretion over moving money around, but they have to keep notes and ask you questions and find out what your needs are, not what they think is going to go up. We're not allowed to speculate and gamble unless you sign a big waiver to do that. And I won't do it. I think if you're a gambler, you should do it yourself. You'll have no one to blame but yourself. I don't want to be at fault for buying a specialty area that's high risk and then it doesn't pan out. 10 to 20 funds, combining index funds, exchange traded mutual funds, which are also index funds, and actively managed exchange traded funds. Diversify among securities, funds, and companies. We mentioned a low standard deviation. On page 68, you'll start to see this stuff. Low standard deviation is the volatility standard of the fund historically, and it's not the same from year to year. It's just an average. So you can look at a fund, or let's look at the large company stocks, a blend of value and growth. Their historical volatility, I think, has probably been around 17% historically. There were times that it was down 65%, 2009 in March. And then there's other times that it's been way up. This is just an average. This is like the grandkids saying, you want to go ride on a roller coaster, ask them, what's the standard deviation? What? What's the historical or the average roller coaster? Am I going to go up and down, or am I going to just have a little kiddie ride here? But we want to know what that is for the fund, so we have some idea of what we're getting into. How has this fund reacted to various markets? And in our case, we can get this number from the combination of funds. How's this portfolio reacted in the past? No guarantee of the future, but we can get some idea. So we want low standard deviation for most of us. If it's for the grandkids, you want high standard deviation, high betas. We'll talk about that because you'll usually make more money in the higher risk indexes, obviously, but there's a lot of risk involved. We usually will want a low beta portfolio and funds that have a low beta. What does beta mean? When we compare ourselves to the S&P 500 or the total stock market index, the NYSE, they're going to give us a number of 1.0. And if we're comparing ourselves, let's say, to the S&P 500, our portfolio, it's not the same because we have 20 different funds and some of them are short-term bonds and cash. Not the same, but we just want to give ourselves bragging rights right now since the market's down. If we have a low beta, the stock market and the S&P is a 1.0 beta, that's average, and they're down, say, 12%. If my beta is 0.50, then I get bragging rights. Guess what? I'm down half as much. I'm only down 6% instead of 4, or instead of 12 rather. So most of us, since it's nest egg investing, want a low beta, low standard deviation. Low is relative, so that's up to you. Low could be, in our case, our beta is 0.60 or 0.50 in this case, where the market's down 12, we're down 6. Alpha, that's an indication of relative to other portfolios with the same beta. So if our beta is 0.50, half of the risk of the overall market, and we hope that whatever they drop, we want to drop half as much. No guarantee. But if we take our beta of 0.50 compared to all the other funds out there, you create a portfolio, we want to have a higher alpha. What that means is our list of 10 to 20 funds in our balanced portfolio that has a beta of 0.50 compared to just throwing new portfolios against the wall to the index and the group of 25, 30,000 funds out there. How do we hold up compared to average portfolios? So we would like a positive alpha to say, because we've done our homework, because we have low cost index funds, because we have really good managed funds, our performance relative to other funds that have the same risk level, we want a higher performance, and that comes by way of alpha. Alpha gives you a higher performance than the average. And what we've done to create that higher performance is low cost funds, better managed funds. So that's a desire when we look at the portfolio. We also want to have a high Sharpe ratio. Professor Sharpe came up with a bunch of calculations, and we want our portfolio to have a higher Sharpe ratio than the index that we're comparing ourselves to. Sharpe pretty much means risk versus reward. We're the funds that we own producing a high Sharpe ratio so we could get a good return relative to the risk. Was it worth it? And so again, if it's a low Sharpe ratio, the risk wasn't worth taking for the return that we received. Moderate to high rated bonds, we usually like that unless it's a high yield junk bond fund. So if you have bonds that you're parking money on the side waiting for the market to drop, or money for the next 1 to 5 year distributions for your plan, then we want to have moderate, meaning BBB to AAA rated bonds. But obviously we know we're not going to earn a lot. We also want to use bonds with a low duration that are very short in maturities. We don't want to be in long-term bonds right now. As of yesterday, which was Friday's numbers, I noticed the long-term, Vanguard's long-term corporate bond fund, so Vanguard's great, not their fault, it was down like 12% year to date, long-term bonds, when interest rates were threatened to go up 2%, but now it's only 1% over the course of the year. They followed their duration because their duration was like 12 or 14. And once interest rates went up 1%, there you go. The long-term bonds, and these are treasuries, dropped by about 12% in resale value. You can wait 30 years and get all your money back, not lose a dime. But actually, if you could make me live 30 years, I'll take that bet. Good. So low bond duration, we don't want long-term bonds in there. Duration represents maturity and risk if interest rates go up. So we want that risk to be low right now. 1979, 1980, you would want long-term bonds and treasuries, lock them in, get 12%. They can't call those bonds, and you would love that choice for the next 30 years. Right now, it's the opposite. High yields, whether it be junk bonds with a really good managed fund or high yielding stocks. The good thing about high yield stocks is that you get a second chance. When they drop in value, if you were earning 3%, that 3% can be buying more discounted shares, let's say a utility fund or something. Or if you had to live off the portfolio and your overall yield was 2.5%, 3%, you might choose to live off the dividends and let the share prices of these other investments come back, hopefully in the long term. But we do like high yields only because they represent current earnings. Now, the high yields is another analogy relating to real estate. Low yielding real estate would be land that we hope that some big company, Home Depot, is going to build a shopping center next door to my land someday. Wow, but it's unknown and uncertain. So you have to wait a long time for that to happen, and you don't get earnings along the way. You actually might have some expenses. The high yielding real estate concept is I want to buy the most condensed real estate complex that has the smallest apartments with the highest rent and get all my cash flow that I can today. And that way the buyer is going to pay a higher price to get the cash flow. But if I'm buying for my grandkids, the land looks like a better deal because they don't need the income. Let's not pay a higher price. Let's pay a lower price, and let's bank on the future. But most of us are beginning to retire right now. So high yielding stocks are good to buy because we can draw the income, we can reinvest the income. And right now it's really kind of bizarre. They're doing great when they shouldn't, when interest rates are threatened to go up because there's fear of technology and other things going on in the world. But be ready that if you have a bunch of high yielding stock related funds, they are interest sensitive. So be careful with that. That's why I like some of these managers will give you some techniques to help you. Now, I have one fund that buys the NASDAQ, 80% of the NASDAQ technology stocks. The NASDAQ's down 20%. But what this fund did was use the other 20% to buy derivatives and things to help protect on the downside. So the fund itself is down 11. That's not fun, but the index that it protected itself is down 20. So it kind of paid off. But be careful when you look for some of these hedging funds because they can be quite risky. I would never recommend going into a fund where they use your money and borrow 2 or 3 times as much. That's pretty crazy. They're leveraging to buy. But those that leverage and the market turns around and goes up make a lot of money possibly. Then you can sell things short and gamble on it going down. Liquidity of the funds. Your portfolio should be made up of all, in my opinion, mutual funds for the diversification factor, but you could buy individual stocks and hedge it if you want to. Liquidity is important. So that's why if you're buying new funds with cash, I would be looking at the exchange traded funds for the reasons we talked about. You can get in and out of them very quickly. It could be a mistake. There could be a volatile day. Don't get scared, sell out and have the market recover, but you have the ability to get in and out of the funds, and you can track how many shares are being traded. You can track how many people are buying and selling. You can track the difference between what you sell it for and what somebody pays, the spread and all that stuff. At least you have that information available to you on exchange traded funds. The mutual fund that you buy and sell through the mutual fund company directly, you put in a request to buy or sell, and it won't happen until the end of the day. You got a 50-50 chance that it turns out better than what you thought. Then had you done something early in the day. Tax-free and tax-efficient funds. If you're building a non-retirement portfolio, tax-free municipal bond funds might be good. I noticed they haven't dropped as much as the taxable bonds when interest rates went up, and it would make sense. Interest rates go up, long-term bonds drop in value, but the long-term tax-free bonds tend to hedge a little better and not drop as much because people are not wanting to get rid of them, and they're going to get a tax-free return, and it's a little more profitable if they're an extremely high tax bracket. All these things start at page 168. If you're obsessed with this stuff like I am, try to learn every single little detail of what these mean, and we're still barely sticking our head in the cloud to know what we're doing. If you're not into it, it's nice to know a little bit about this, so when your relative or your partner or your advisor talks to you, you have some idea. Or if you've hired an advisor and he or she says, wow, I'm going to go out and buy something that's way overpriced and has a very high beta and high standard deviation, a low Sharpe ratio, run the other way because they're not listening to what your needs are. But I'm assuming we're all nest egg investors here. Okay, here's what a portfolio might possibly look at. No guarantees. This is educational information only. I'm not saying this portfolio would work out for you, but let's see what an average balanced portfolio might look like, the components. It has a, of all the funds in the portfolio, the internal allocations might be 2.62%. Among all the funds might be in cash, meaning they're fully invested, not a high cash position. 52.4% of all the funds in the portfolio run through a blender, 52.4 in bonds, so 2.62 in cash, 52.40 of all the combined bonds in the portfolio. Then other might be preferred stocks or convertible bonds that are a little different, 7.62. Like I say, could be those two things, and gold and other things. Also, the stocks, this slide doesn't show them, but it's down here, 34.70 US stocks, and then non-US might be 2.66. Now, is this a good time to buy non-US stocks? Well, it's a great time relative to the last few years. Prices are lower for obvious reasons, conflict in Europe and that. I don't know. If you load up on them today and the market falls further and they have greater conflict, it was a mistake. If things get settled and those companies are safe and stable, then we might have bragging rights and say I bought a lot more. It could very well be a time to add 2 or 3 or 4%, see what happens, and add a little more in the future. Remember, we're not speculating, but you can buy contrary to the market. And when there's a buying opportunity when things are down, utilities, not today, but a week or two ago, were down also. And I didn't do any buys there, but I thought, let's see what utilities do. And then they reversed themselves. But you could decide if you want to be contrary to the market. So cash 2.6, bonds 52.4, 7.62 in preferreds, 34.7 in US, and then 2.66 in non-US. Today, we might be looking a little more in non-US for the reasons I mentioned. Up to 10 different funds and ETF companies. And these are the companies: Vanguard, Schwab, Fidelity, T. Rowe Price, iShares, WisdomTree, Invesco. I would like a portfolio with representation of all the biggest companies for the reasons I mentioned. I don't know that I want to go to unknown exchange traded mutual funds that aren't well known. They might be too small. They might not get enough money to keep the fund going. They might have to sell everything, send you the cash, and now they might have gone up a lot in value, but they have to go out of business. Now you've got a tax issue. So I would stay with the bigger companies unless you do your homework. Now, where do you do your homework? I'm not endorsing this, I don't know what they are. Thing on iPod or something, but I listen to ETF Prime, P-R-I-M-E, ETF Prime. Go to the iTunes, and they're ETF geeks, really nice people, and they're always talking about the next ETF fund coming out. And when they're talking about, wow, it's up, $500 million. It doesn't mean the stocks in the fund went up. It means that fund is collecting that many investors. Kind of fun. So ETF Prime on iTunes, if you're into this stuff, or if you're into visually getting some opinions, ETF.com is another website that's pretty good. I'd send you to Morningstar, but they're so complex and you have to buy and subscribe. But that would be another one that would be good. And I'm sure there's many others out there. Different companies, up to 20 different funds. 10 is fine, 12, maybe 15. This portfolio might have an average of about 3,611 stocks. We call those equities. And then in the fixed portion in bonds, preferably today would be ultra short-term, or CDs and cash, 20,000 different bonds. Reason for so many bonds is that they are issued on an ongoing basis versus the stock market. Companies issue stocks. They have to go through the SEC, and it's a regulated process. And there's less publicly traded stocks than there were probably 10 years ago because the companies have been buying themselves back. We've all heard of the Wilshire 5000. Well, the Wilshire 5000 probably has 3,600 stocks in it today. So we'll see. So this portfolio is mixed among all the categories of investments with the funds it's using, among the companies, and among the equities and the bonds. But we don't just go out and buy the total bond market index fund today simply because it's the total bond market, because let's say a third of it's in long-term bonds. We don't want that. Then again, I could be wrong, and interest rates never go up again any more than 1%, and boom, they go up in value. That's the dilemma. As soon as I say one thing's going to happen, there's 100 million traders and other governments that can determine something different. So you need to make the portfolio match your needs, not what some economist says what happened after the fact, or somebody that says we think this is going to happen. I love listening to those shows while I'm ironing my clothes in the morning, but it sure doesn't mean that's what's going to happen. Listen to all the people that said Putin's going to get all his army and everybody outside of Ukraine. He'll never invade. Okay. And then listen to all the people that said it was a good time to get into the emerging markets and international and global. They were pretty much right, but how did they know what's happening? So you do the best you can, but if it matches what your needs are, then you're going to hang on to it. And in the long term, you'll usually benefit, but we have short-term, intermediate, long-term levels, so you can survive no matter what happens. The water buffalo always come back to the pond, no matter what friend of theirs got eaten by an alligator. I'm not guaranteeing anything, but we all need to get up in the morning, have our coffee, have our breakfast, go do what we're going to do. And I believe things will get back to normal, but I can't guarantee it'll be within weeks, months, years, or even decades. So that's why you plan accordingly. Okay, this portfolio might have, just saying, not exact pyramid shape, but it might have 45% of its total holdings in total market index funds, total bonds, total stocks. Biggest, widest, broad-based funds, lowest cost, have it at least with 2 different companies, maybe 3 for the reasons we mentioned. 40% might be in the middle part of the pyramid, could be specialized sector indexes, like we mentioned, or factor funds, ones that combine indexes, and every year, every quarter, they rebalance. They all have some magical formula. Go with this, go with that. Well, if one of them does what you want them to do, then that formula works for you. You buy that strategic beta index fund. Its expense ratio will be higher because you're asking them to go in and do something. It's kind of like, if I'm going to sell my house, the index fund is like an empty house. The middle part of the pyramid, or a strategic beta fund, might be a little more like, I'm going to stage the house and I got to pay somebody to move the furniture around and make it look better. Okay, they're doing strategic beta, meaning they're going to do some allocations that are going to be a little different than the overall index. And if you like what they're doing, then you pay a higher management expense, not a problem. And then we get down to the top 15%. This is hypothetical only, of managed mutual funds from the past that haven't upgraded to an ETF, or exchange traded mutual funds that are the new thing, but they can also be very aggressive in managing it. Because 10 years ago, the ETFs that I was buying were mostly some form of low-cost index fund. Today, we have exchange traded mutual funds that are very managed, but no surprise, they have a high expense ratio. Some of them are egregious. So look at what the expense ratio is. And if it's on average 25 basis points, 0.25 or 0.35, and they're doing something you love, okay, I've seen 0.45. I have a preferred stock fund in addition to that other one that's not an ETF that has extremely high expenses. I have another one hoping that I can use this more, but it hasn't proven out yet. The less managed exchange traded preferred stock fund has an expense ratio of 0.45, almost half of the other one, but it hasn't outperformed the managed fund. But I do use them both because I hope that we'll get there at some point. So the top of the pyramid, and this is inversely here, the base, the mid, and the top, our top is at the bottom. 15% of this portfolio are with top managed exchange traded mutual funds or an old mutual fund that you just love its track record and its past, and you'll buy it. And you don't need to buy it within the moment to get the perfect price. You're going to buy it and hang on to it. One fund I'll say, and I'm not endorsing it because I think that it's close to new investors, might be T. Rowe Price Capital Appreciation Fund. You look at that and it's has great management. If you go back 20 plus years, I think it's outperformed the S&P because it picks stocks in the S&P that it thinks will be winners, and it excludes ones that it doesn't like. So it has a long-term track record of doing better than the S&P, but in the short term, it may miss out when technology takes off because it allocates differently than the S&P. I think that fund's closed, but you've seen T. Rowe Price Capital Appreciation Fund in your old 401ks and things. If you have it, great, keep it. It's done really great, but I don't think you can get into it if you're new. Combine portfolios past 10 years risk matrix. You want to look at the worst period. The only benefit that the crash in 2020 had, or recently decline in the market, is that it'll let us see charts for 10 years that have some of those in it. Up until March of 2020, the 10-year chart just went straight up through the roof and could very easily be misleading. An advisor could be saying, here's the portfolio I want you in, and look, it's done nothing but go up. Well, that was without any downturns. Now we have a couple downturns. You can get an idea that when you combine all the funds in your portfolio, what's the worst performer? And it usually, we go back to 2008, it was down significantly. This portfolio was down 17% when the market itself was down about 50% or less. It dropped as much as 65, but it was down 50% as less. You won't see this now because 10 years have moved us into a new cycle, but you will see March of 2020. We'd like to know what this portfolio had done. So going all the way back, this portfolio dropped as much as 17%, which is very favorable when the market was down 50. But from this point forward for 10 years, we would have far underperformed the S&P 500, who recovered in 5 years and took off. So there's never a perfect combination. I'm loving the market being down, calling my clients saying, guess what? The market's down 12, you're down 6. But the trade-off is, in the long term, the market can blow us away if it keeps going up and the risk investments do better. But a lot of us that are investing nest eggs, we want to know, how do we reduce the risk? Last 12-month yield in this portfolio was 2.2. You'll learn in the book something called SEC yield, means the share price of the fund versus the yield for the last 30 days, which the share price may have gone up or down, but the total yield is the price for the whole year relative to the return. So we have a total yield of 2.2%. Just saying, maybe different. If we ran the same portfolio on Morningstar, it would be completely different. 10-year standard deviation on this portfolio, since its balance is only 7.5%, about half of the S&P 500. 10-year Sharpe ratio, 1.45. We get 0.45 more than the overall stock market. So we get a better risk reward ratings. Our 10-year beta is only 0.38. Well, we're loving that today, but we're hating it last year. It's going to drop 3.8% possibly, or has, compared to a 10% decline in the stock market. So we love it when the market drops, but it's not helping us on the way up. But if we're nest egg investors, we just want to keep pace with inflation. If the market crashes, we want to know we can get some of our portfolio back without, I want to say this bad English, without no loss, and then minimal loss on the intermediate, and then we wouldn't touch our long-term stock. R square, that's kind of how similar to are we to the overall total bond market, total stock market. We're about 90% similar. That's good. We don't want to be 100%. We like to have some non-correlated assets that are not affected when the market falls. But then when, let's say, the market, S&P, which is mostly technology, goes up, those non-correlateds probably sit there like a lump on a log. Our average credit rating is BBB. We need some yields. We can't go AAA. I'm sorry, they don't yield anything. You have to go down in the higher risk level. I wouldn't mind an index fund of BBBs, but BBBs and below, I'd have a manager watching out over those funds. Average bond duration, 3.3 years. If interest rates are projected to go up 1 full percent, they might drop 3.3. A lot of the funds here actually haven't dropped that much. They maybe dropped 2%, but we didn't want to be parked in CDs and get nothing. Our short-term bond funds, even though they're down 2%, are earning 1.8 to 2.5%. So we'll earn that back. And if interest rates go up again, they were able to buy newer bonds that might be in higher rates. Average expense ratio, 0.19. Remember the base of the pyramid. You could get a total market index fund as low as 0.015 if that's all you want. But then now today you're down 12%. That didn't make any sense. So why not? Let's go break away from that and bring our expense ratio up to 0.19. And we have a handful of managed funds, but most everything at the base of the pyramid help bring our average cost down. I do this for clients. I don't want them seeing an extremely high cost for all the funds because I'm going to slap on my management fee. So I like the fact that this pyramid brings the cost down to 0.19. I dare you to look at your portfolios or an individual fund and see if you're lower than that. If you haven't updated it to lower cost funds, it might be significantly higher. And unless those funds are producing something really great, it might be time to look around to do a switch. But that said, if it's not a retirement plan, make sure you calculate what the taxes will be. Oh, wait, there's another saying, you don't go broke taking your profits, and then taxes may go up in the future. We got 5 different arguments for doing any one thing. If I speak right, if I manage money right, I'm always going to speak with a forked tongue. We can go to the left. Here's a reason to do it. No, wait, go to the right. Here's another reason to do it. So would you sell an old fund that's up a lot because the market's risen, but it's a terrible fund, and pay a huge amount of capital gains tax? See your accountant and make your decision. You could start selling it off a little bit each year, or you could do it all at once. If you believe interest rates or taxes rather are going to go up in the future, some people choose to sell it all, pay the tax, and get reallocated if you want to. Okay, so worst years, last 12-month expenses yield, and then 10-year standard deviation, 10-year Sharpe ratio, 10-year beta, R square, then credit rating of the bonds, bond duration, and expense ratio of the fund. Some very, very important elements. If you want to be a tactical investment person, you're being a contrarian, so you're going to go buy stocks in Russia. I don't know that you can, but let's say you could. You're going to go out and buy stocks in various other places that are in very high risk and have dropped a lot. You would look for what's down. Technology would be one area that's across the board that is down. Stay diversified among sponsoring companies, among internal funds, and then thousands of internal stocks. This was a mistake, although if you're aging, do you need some help? Let's go in here, some last minute things, and I'll bring over a Morningstar portfolio for you so we can see what it actually would look like using some of these components. Creating a portfolio in a brokerage account on your own, family member, or with an advisor. I would just mention, and these are my opinions, these are not facts, because we'll never know which allocation was right until after the market closes. I wouldn't do any more than 3% in any single emerging market fund. preferably no more than 3% in the whole portfolio. But if you like those, I wouldn't leave very much in one particular spot. You never know. They could be in the wrong emerging market part of the globe, and you don't want to load up on that. I wouldn't do any more than 5% in any single high yielding bond fund. That's going to be a risk because those bonds could go bankrupt. Now, even in bad times, I've seen very large high yield junk bond funds. They know 3 to 5%, maybe 6% are going to go in default, but because they're earning many times the yield of short-term CDs, people are willing to take the risk of that default because you're earning such a high yield. A junk bond fund might be paying you 6%. And so if they lose 3% of the portfolio in bankruptcy, and it doesn't mean they won't get the money back, some people are willing to take that risk because the yield is twice that many bonds going bankrupt. Theoretically, just saying, I wouldn't get too heavily into one. If you love junk bond funds and you want 15%, maybe do 3 different companies. They'll all have a different view of how to do it and probably managed. No more than 5% in any one sector fund. We talked about those, utilities, technology, pharmacy, healthcare, all the different areas. I wouldn't load up on too much in one. If it dropped a lot, you could ease into something. If it's something that's been up and down, like utilities and technology. I wouldn't do any more than 10% in any one equity fund, a stock fund, whether it's large cap value or large cap growth. I would rather keep it to 10% for reasons I don't know of. The manager could make mistakes, or if it's an index, that index could go south on us, like the S&P is having difficulty. But the NASDAQ, the 100% all technology, is down 20%. Now that's normal. It's a good shakeout. Might be time to say, you know what? I never liked tech stocks before. I'm starting to like them. I think this is my second chance to move back into them a little bit and rebalance the portfolio based on buying opportunity. I'm just saying that's a possibility, because in the day of investment funds, we're buying things that get bought and sold throughout the day. We're only getting a good price because everybody else thinks it's a bad price. So we're going against the crowd. We're not buying into something that hasn't gone public yet. These are funds that are publicly traded. We don't get a good deal. We just get what somebody else is willing to buy or sell in the moment. We'll have to plan out the future of where we think the market will go. No more than 10% in an international or global fund for obvious reasons. But if you like 30% of your portfolio, then get 3 different funds from 3 different companies for the reasons I mentioned. No more than 12% in a single balance fund. I found one balance fund that has bonds with a duration of 4.5, meaning midterm to short-term bonds. But most of the balance funds that I love, their bonds are way too long-term. And I know one of the bond funds is down a lot because the bonds in it were long-term bonds and the stocks in it were tech stocks. So here's a bond fund that's down 17%, as much or more than any of the bonds or the stocks. So you need to look and see what's in it, because that one bond fund I would talk about, it's with a very big company. The expense ratio is 0.07. And I would tell people, I love it, but the bonds are long-term on the bond side. And now it's taken a double whammy. Tech stocks and bonds, long-term bonds are down, and that fund's down a lot more than most balance funds. But the balance funds tend to get carried away with the yield on the bonds, and they don't mind buying longer-term bonds. I don't prefer that. I would rather have you buy a short-term, ultra short-term bond fund index, and then maybe the stock funds, and create your own balance until maybe things stabilize. No more than 15% in any single investment grade bond fund. Investment grade's not a lot of fun. Triple B's up. They're not going to earn very much, maybe 1.8, maybe 2%. But these percentages are just ideas for you to prevent loading up on something where we have recency bias. I'm going to buy energy. Wow, look at how far it's up. That's a mistake. Plus, a lot of people don't want to endorse the dirty burning energy company. Okay, I'm going to buy clean energy. Well, that's a lot of tech stocks, and that tanked big time. So it's better to step back and see the allocations match what your needs are. You can also along the way pick the environmentally, socially, governance regulated funds, although there's a lot of fraud there. So go with the bigger companies who are under more scrutiny. And you can avoid buying companies that use carbon products, and you're taking a little more risk because they're not as popular yet, but they might get there and it could be a good time. Rebalancing the portfolio. If you go to a large name out there, brand name, I mentioned lots of them, and they say, we'll manage your money for you, go to a big investment company. Well, if they're really, really, really big and they ask you what's your risk tolerance? Well, you know, I've done this 42 years. I don't know what the risk tolerance levels really are. I can take a 50-50 portfolio and give you conservative short-term bonds, AAA, and conservative blue chip stocks. Or I can turn around and buy high yield long-term bonds, and I can buy high risk technology stocks, still be 50-50, and their program is going to rebalance me. When the stocks go up, it's going to sell some of the stocks and buy me more long-term junk bonds. That's silly. Now, they have different allocations than that, but having a computer reallocate the portfolio, why would you do that? You can buy exchange traded mutual funds that will do the same thing. They'll buy all these different indexes and they'll rebalance quarterly or once a year. And the expense ratio is a lot less than paying some big company 1% a year to buy their own manufactured exchange traded mutual funds. So I don't believe in automatic rebalancing. I do believe in interactive rebalancing, where you talk to yourself or the advisor talks to you on a quarterly, semi-annual or annual basis and saying, look, this is up and this is down. I want to sell some of the up and buy some of the down or rebalance it. Yeah, absolutely. Because that'll help you keep in your risk tolerance levels stable, which is relative, because now you're getting Social Security and other retirement things. Maybe your risk level's gone up and they're not going to ask you that. They're just going to automatically rebalance it. And you're buying into a computer algorithm for 1% a year. What are they doing for you? If you're going to pay 1%, give or take, you want to work with, in my opinion, a concierge, a financial advisor who has staff that'll handle all the RMDs and I need money, I need to invest money and do everything behind the scenes, or do it yourself. But going to these big companies that put you in an algorithm managed portfolio that automatically rebalancing, you can do that on a robo-advisor. It's just silly. We talk about these on page 176. Rebalancing, absolutely. But what if you started Social Security, you sold some properties you're taking money over your lifetime on to reduce taxes, you got your pension, you know, this thing is really for the grandkids. Oh, well, our rebalancing shouldn't be going to getting rid of the stocks that went up. We need to be selling some of the bond funds and getting into the stock market, because you had a dream last night of I should give this to the grandkids. I'm going to put it in a trust, make it for them, and they're younger. The rebalancing means upping the risk, not reducing it. So automatic rebalancing, in my opinion, is absurd unless you're buying a fund that does that for a very small fee. But rebalancing, selective rebalancing, is extremely important. So I think if we're finish up on these, and I'll bring over the Morningstar slide. So recap, select a group of indexes, exchange traded managed mutual funds, enter the funds in a portfolio software system if you can. I used to think they were at the local libraries, but I'm not sure that they carry it. But see if you can go somewhere, enter the funds that you have into the Morningstar software or anyone else that will give you the outcome of all of these risk parameters that we mentioned. That would be good, so you have some idea of what this portfolio is doing with a mixture of funds. Because I have recently, I've seen all these tech funds drop a lot, and I bought little bits and pieces of those for some clients. And I'm thinking, oh no, I'm down like 25%. But when I look at the percentages, they're way at the bottom and they don't even show up. So it's not as scary as possible. But you need to see your portfolio and see what it ends up, what's the end result, have a diagnostic done. Review the combined group of funds for the combined historical risk and expense ratios. And we went through all of these already. So the last thing on this slide presentation before we go to Morningstar is this reminder: past results and statistics are no indication of future performance. I have no idea what's going to happen in 2 minutes. So these are concepts for you to create portfolios, but please don't assume that that's the way they go. If this particular slide is there, you should be seeing a Morningstar slide, and I'm going to make it a little bigger. And this little thing has been going from red to green to red to green. I don't know if it's the craziness in the market or they just have a glitch today. But let's take a look at a model portfolio that was created a while ago. This is a balanced portfolio. This is an old allocation, I think a year ago. But you'll see all these different funds. Here's one called Cohen and Steers, but you'll see Fidelity. Oh, wait, I've heard of Invesco, right? If you're into this. iShares, you'll see some of their ads. Schwab, you know who they are. T. Rowe Price, you've seen in some of your old 401ks and their advertisements. SPDR, this is State Street or Spiders. That's that little pie chart ad you see on television. And who's that? Anybody here of Vanguard? But you'll notice they're not all Vanguard funds. One, Vanguard is a big company, so I don't want all my eggs in that basket. And plus, they'll create a fund after it's already become popular somewhere else. Why would they waste the money trying something new? Invesco and Wisdom Tree and some of these other companies will go out and start new funds. You've heard of ARC with Kathy Wood. Here's the one fund that is extremely high expense ratio that normally on the surface, oh, that's not it. This is the short-term one, which is good, 0.60. It's a gold rated fund. That's a high expense ratio, but the yield is still, if you've had it for a while this year, you're earning 4.3. And if you're buying it now, you're still going to get 2.30. And it's been a lot less volatile than the actual preferreds. Here's its sister fund that does nothing but long-term preferred stocks. It's Quantitative Rating. That's a new word I started using a year or two ago. I'm a late bloomer. 5 stars is quantitative, meaning in its category, it's in the top 90+% of all funds. They have a silver rating for whatever, probably because the expense ratio is really high. Morningstar gives it. And this little Q means that the computer algorithm gave it this rating, not actual people. They have too many funds to rate, so they came up with an algorithm. If you've held this fund from the beginning of the year, you're getting 5. If you buy it today, and I don't know why, the price is down more recently, but for the year, you'll be getting 3% for the most part. Turnover is about 49%. So I'm not saying a high turnover fund is better than a low turnover index, but if they're doing something I need them to do to protect me, then I want them to be doing some turnover and making the high fee that I'm paying worth it. So let's see if the turnover is worth it in the long term and the expense ratio. So you'll see this fund in the blue has far outperformed the preferred stock index in the red, and then other funds like it in the yellow. So in the long term, it's been pretty good in giving us a better return, but I really don't worry about the upside. My biggest question is the downside. So let's see. The downside of this fund in the long term is about the same as the index, but the yield is higher, but normally it tends to fall in the short term a little bit less than what the indexes have done. So I've looked at PFF, which is a long-term preferred stock index. It's down more than this fund. It's down, I think PFF this one is down what? Year to date, 6%. But the PFF index is down about 8 or 9. So it saved some of our numbers on the way down, and I'm willing to pay that higher cost. But you may not want to. And if you don't care about the management, PFF, which is a preferred stock index fund, is much lower expense, but it's fairly volatile. Here's a Fidelity consumer staples. The good thing about this is consumer staples are products people are going to need, whether there's a pandemic or a war. The yield for the year has been about 2.2. 2, right? 4 stars, pretty good. Expense ratio, 0.08. This is, in my opinion, Fidelity trying to compete with Vanguard. So Vanguard's might be slightly higher, but Fidelity puts out these exchange traded funds in competition with everybody else. So when we historically see this, you can take another sip of your wine. It's not you, it's the program. So don't worry about it. You're not losing your mind. I thought I was. 0.08 is a very low cost for a sector exchange traded fund, meaning they've got to go out and buy just consumer staples within an index. And it's a little bit more work because there's a lot of competition to do that. I'll drop, if I can, if this software is going to let me, down here to let you see what's in it. I have one great disappointment with this index. Procter & Gamble, great, love it. Coca-Cola, great. Costco, great. PepsiCo, Walmart, oh, Philip Morris. We don't love that, but that's a high yielding dividend stock. So if you're not constrained by that concern, an Altria, then you'll buy consumer staples. They tend to be more stable through the ups and downs. But if you're more socially conscious and don't like that, I'm still looking for a consumer staples fund that excludes tobacco. Sorry for that, but that's the only one. They're all like that. But I'm sure there will be one coming out soon. Here's a Fidelity Utilities. I'll tend to use a few more Fidelity funds because they let us trade for free as long as they have a low cost here and a high yield, 2.85. They're pretty much going to do what everybody else is doing. So it's more of a, see the word index. So if they all subscribe to the same index, they're going to have the same allocations. This fund is in blue and it mirrors the red, so it does exactly the same. So you're not getting any benefit over an index other than letting them put you in it and buy these things for you. The trailing returns year to date, utilities are only down 0.19. Now they were down about 7% for a while there. That's when I kicked myself. I should have bought some more. Now they're only down 0.19. That's pretty cool. But I think it was that, I think what happened is when the Fed said, look, we're not going to raise interest rates 2% this year. We're just going to maybe only quarter. Then I think there was a big sigh of relief on the utilities and people bought back in. And so now they haven't dropped much. They've actually gone up at various times. Because like for the month, they're up like 4.8%. Go figure. So there's always a reason for all this soap opera drama stuff. And if you have the time to learn it, you can get it. If you don't have the time, just flip through the book to make sure that you don't get taken advantage of, or you don't have an advisor who's just saying, sure, our home office manages money, and for 1.25, we'll put you in their conservative growth portfolio. Isn't that great? And then stand there and stare at you. I mean, what's the point? So if you have somebody on the outside manage this stuff for you, they should know everything here. If you have an advisor that you like and you don't want to fire, have them contact me. I'll teach them how to do it. I don't mind. But let's get you in the right place. These are utilities, great buying opportunity a few weeks ago. They're a good hold right now. You could buy a little more now, but this is what they own. Next Era, Duke, Southern, Dominion, American Electric Power, and all the way down. In my opinion, these electric companies are going to start working with the government doing charging stations for electric cars, because electrical companies just transfer energy. They don't make it. So it's a good possibility. You'll see Tesla or whomever hooking up with these companies, and the high tech is going to turn into utilities, or the utilities are going to turn into the high tech. The utility index funds are all going to do about the same thing. You'll see Fidelity here because we can trade for free. Vanguard, it might cost a couple dollars. Actually, the exchange traded funds don't cost anything because the Fidelity and the trading companies make a spread. If it was a mutual fund from Vanguard, you might get charged $10 because they're not getting anything on the spread and trading it. But they'll all have about the same thing. Let's move out of Fidelity. Invesco Preferred. Here's another one, just so we didn't have everything with that one company. The other one we saw was down, and this is an exchange traded fund. The other one's a managed fund. If they give us our information, yield on this is 5%. That's a lot, but there's always a reason for it. Expense ratio 0.55, not bad. It's down like everybody else, but see, it's down 9% year to date. This is a lower cost exchange traded fund that I put on this list to see how it does, but that other staunchy old huge management fee is down 6. This one alone is down 9. So go figure. Let's not shoot the old managed funds yet. There might be some that will do a good job. This is a good preferred stock exchange traded fund, but it doesn't manage the downside. Here's one that does. S&P 500, but magically they say downside hedged. Well, that may or may not pan out for you. We'll see. Expense ratio 0.40. Yield is extremely low. Let's see if we got anything out of this hedged part. And Morningstar gives it a negative, so they must not like it. I threw it in there just to see. Obviously, it's not down as much, but it didn't go up as much as the overall S&P 500. So year to date, though, it is down 3.60, and the market's down 11 or so. So on the short term, this fund panned out. But in the long term, you saw that other chart, it didn't grow much. But maybe if it can grow a little bit each year, let's say the 5-year return's 9%, 3 years at 11. So I was ready to beat them up, but what can I say? It's done okay. It's pretty much given you that hedge, and I don't know what they're doing to hedge. You could read it and see what they have. They have risk category is below average and return is above average. You had me at hello. I love that. The alpha is 6.20. That's really high. So whatever they're doing to hedge this is pretty good. And the beta is 0.20. So they're doing something to reduce it, the risk. So I'll have to pat myself on the back. Not a bad choice. Standard deviation 9 versus 18 in the overall index. Wow. The worst time, the drawdown, it was down 6 when the market was down 20. So I'm liking this fund more. Here's the assets, a lot of cash. That makes sense why it's not down as much and not up as much. Other might be preferred stocks or convertible bonds. That makes sense. And no bonds. So they're doing nothing but cash and short term. So they haven't dropped because interest rates went up. They didn't grow much in that one chart long term, but in the short term, they sure helped us not drop very much. Now, let's see what kind of bonds are in it. And stocks, well, no bonds. Apple is a big one, Microsoft, Amazon, some of these big technology companies, but they have a lot of cash. So they balance the technology with the cash, and they have 500 stocks. So you might look at, if you're into doing that yourself, look at the stock ETFs that have done the best and just look at what their little explanation is and why they've done so well. iShares, let's pick out, here's a high yield defensive. Again, you will need to bought this before the downturn in the market. I think this is high yield bond, should be, if we're getting 4.8 or more recently, because the price has dropped, you buy the high yield defensive bond fund. I don't know what defensive means yet. You're going to get a higher yield than somebody that bought it last year because the prices are lower. So you're buying at a lower price, same yield, equates to a lot higher return. It has done better than whatever index it's following here. So that's pretty good. But of course, it's down like everybody else. Why is it down? Because junk bond companies, we fear they're not going to pay us back if the market crashes. But look at this. They're only down 5.10 junk bonds. The stock markets, as of yesterday, was down more like 11%. So those of you that have courage say, to heck with that. I'm going to keep my junk bonds because I can earn 5%. It's only down 5. I'm going to heal that in 12 months if I don't buy no more shares and they don't do anything. So that's another way of looking at it. But in 2020, there was a lot of fear that these junk bond companies would go out of business, not pay us back. So junk bond funds dropped. Let's see if it goes back to 2020. No, they don't. They do. Well, these are the full year. So parts of the year, junk bonds were down, I'm guessing 35, 40%, because if somebody's not going to pay you back, the bonds are worthless. So, but in this case, iShares, a very ESG responsible company, not necessarily with this fund. You're sitting there wondering why I'm not getting down to the holdings. Yeah, Occidental Petroleum. So this is not an ESG fund, although iShares is going in that direction. Uber Technology, they drive around a lot. So, and they have PG&E in here. It's been a long time since I've seen that, but maybe the companies feel that PG&E settled a lot of the lawsuits and they're getting ready to go. But this is a fund that has done very, very, very well, but you may or may not like what they're doing. You like how they've done, but not what they're doing. Let's just give Schwab a shot at it. One, we want to be with Schwab because it's a different provider. Also, when they want to, they can get costs quite low, but here it's still a 0.49, a 0.5% expense ratio, $4.5 billion. That's a lot. The yield is 5.66. That's a huge amount, but the word international is letting me know that there's more risk in international markets today than US. The fund is not exactly laid out as the index and hasn't grown as much, but it might show that it's dropped a little bit less because they decided that this is a select dividend fund, not an index fund. So it hasn't grown as much as the index, but let's see if the risk has been a little bit less. Yeah, year to date, look at this. The index is down 12%. This fund's only down 3.82. So we trusted Schwab to pick the top dividend paying stocks that they believe were worth holding. And although in the long term, we didn't perform as much, look at that. The index is down 12 and you're only down almost 4%, about a third. So was that worth it in the short term? Yes. Again, if we invest a portfolio for stability and safety from point A to B, year 1 to year 10, we're not going to usually do as well. But there's going to be in 10 years, let's say 5 different downturns, and you might be needing money during one of those downturns or scared or worried. We get several options to have bragging rights, and this fund has them right here. Now, we saw in the long term, we got slapped silly, but in the short term, this fund really came through for us because they were not in the total index with technology is heavily weighted. If this program will let me go down quickly, we can see what's in it. Here's a tobacco company. So you may not like that, but there's money in tobacco, unfortunately, and in energy and all that. But they're just doing the best they can to give you the highest yield and the most stability in price. And sadly, I'm sure tobacco doesn't drop in demand during difficult times. But that's something you'll want to know. And if you do this yourself, if you have a problem with that, make sure that you screen the funds for negative positions that you are against. And if you don't really care, then you'll screen for something else. If you have an advisor doing this for you, he or she needs to screen for that if that's an issue for you. And remember, the ESG funds, environmentally, socially, governance, don't always continue to rise because not as many people have invested there, and the positions that they've taken to do the right thing may not be as profitable in the long term, but it's definitely the right way to go for most of us. T. Rowe Price, this is not the T. Rowe Price Capital Appreciation Fund. It's not available to new buyers. This is their institutional, meaning banks and insurance companies and lending companies, floating rate fund. They will buy securities from these institutions that were just lent to contractors, small business, and upstarts. So they're junk bonds, meaning they're high risk. They could fall into default. But apparently T. Rowe Price does a good job managing them. They're on the top 90 to 100% in look back or in the Wayback Machine or historically. Morningstar gives them an analyst rating of gold. Actual people have looked at this fund and rated it that. Now, this is an institutional fund. You may not be able to get into it, and its expense ratio is 0.58. It's possible the public one could be much higher expense ratio. The yield is 3.98 historically from January. And then if you just recently bought it, it averages out to about 3.32. Turnover 63%, probably because these are short-term securities that mature and they have to buy new ones. If you're willing to do the floating rate, which means ultra short-term maturities, but junk bonds and securities, if you're more worried about interest rates rising than companies going bankrupt, well, this fund has done pretty well. It's in the blue. It's outperformed other funds created like it, and it's outperformed whatever index they're following here. So the fund has done well compared to everything else. Year to date, check this out. We must not be worried about the end of the world because the investors here are feeling confident that the borrower is going to pay back their loans. And this is a floating rate, so it's going to adjust and you don't get hurt when interest rates rise. So here we go. We're a negative 0.65 year to date. Whereas if you had a long-term corporate bond with Vanguard, it's not Vanguard's fault, you're down 12+%. So I've been talking since the beginning of this class to go and keep short duration bond funds. Now I have clients that have this, but I don't have a lot of it because it's junk bonds. So, okay, we go to the investment grade plus short-term junk bonds, but they're down 2%. Let's give up the fact that we think we're going to gamble on one thing and then publicize the fact that I gambled it all on this and I won. That doesn't work for the rest of us. We need to live off these portfolios. We can't lose a bunch of other people's money. This is our money. So it doesn't mean that this won't drop going forward, but 0.65 means that this fund has protected you from rising interest rates. Fabulous. And people aren't as concerned about bankruptcies and things. I don't think we'll recognize the companies whose bonds we hold. And some of them may be petroleum companies. So if that's an issue, you need to look at the portfolio itself. SPDR Utilities, Vanguard Emerging Markets. Let's go to Vanguard's Dividend Appreciation Fund. And I'm going to glance at the portfolio once we're done with this one. It's a 4 out of 5 silver rating, good fund, not a problem. Its expense ratio, because it's so large, $42 billion is only 0.06. And it is an index fund. So it's buying high dividend yield index funds. Somebody made up an index somewhere. And this is what the chart looks like. They're a little less than whatever the index has done, but they might be down less. So let's take a look. Yeah, year to date, they're down 2.96. The index is probably down more than that. Yeah, the index is down 6%. This fund is only down 2.96. Sorry, I'm dyslexic and it's a long day. To see what funds or stocks they have in it, we can see there's more financials in it. Financials are under stress, but they're not all financials. Johnson & Johnson, JP Morgan. So you can see these little icons here. There's a good mixture of what they hold. And so they're looking for high dividends, strong balance sheet, good companies. They don't rise as much as the index, but they definitely helped us not lose as much. Okay, so let's take a look at all these funds mixed together. And let's see. Here's what the portfolio looks like. And this was back in November 2020. So I'm definitely, please don't follow this portfolio. It's way out of date. This is the typical old pie chart and all this stuff. Have no concern for the man behind the screen, the curtain, as they said. You're going to get this on all your pie charts and statements. Don't have time to go into great detail here, but this style box tells me that large, medium, small stock funds are held, value blue chips, growth like Amazon and technology, and then a blend of both. So I want to know that I've got a good mixture of all of the small, medium, large, but most of the money is in large cap because we can depend on them. They've hit their heydays. They're there. They pay a dividend. They might give us some growth potential. The large cap growth companies will give us more upside growth if they take off, but those are more technology. We're a blue chip investor looking for a nest egg over here. If you're looking for growth, you stay in the growth side, and you definitely have huge buying power today, and you might have more buying power next week. I don't know. The bonds, they're called fixed income style box. LTD stands for limited term. We don't have, there's 9% here by default, but basically we don't have moderate or extended bonds. We have just short term. Low credit rated junk bonds, medium investment grade, high grade mortgage, government backed mortgages or something is in there. Don't have time to go into this, but our little chart says in this little pyramid that we're more in the defensive side. I'm sticking up for those of us that are nest egg investors. If you're more aggressive, you could go to cyclical and try to pick the next best thing. And maybe markets will rebound and technology will come back and it'll do fabulously well. So maybe we're looking at some good contrarian buys. That's up to you. Don't have time here, but cyclical has all these invested in it. And then the sensitive areas, energy is doing great in numbers, but horrible if we stop using it or we get to other technologies. Defensive are down here, utilities, healthcare, and so on. This chart is interesting because this portfolio itself, which has, I don't remember, half in fixed assets, half in stocks, in this 10-year period has done almost as well, but much less downside than its benchmark, which I believe is the New York Stock Exchange. And this is PR, price, not reinvesting the dividends, just the price of the stocks in the New York Stock Exchange went from this point 10 years ago to this point today, a little higher than what we've done. We're reinvesting. We have half bonds. I don't expect to do better, but on the downside, look, we didn't drop nearly as much. And on this downside, and maybe that downside and that down, 1, 2, 3, 4, 5 times we had bragging rights. But if this is for the grandkids, obviously we probably want all stocks and just go for it. Worst case scenario, 2020, we were down 11.42. The stock market was down as much as 35, but averaged a little over 22, 25%. So that makes sense. We were down about half as much. Again, nest egg investor, that feels good. An aggressive investor, they would say, are you kidding me? That's a joke. I want something more aggressive. So that's fine. This chart here, this box goes like a diving board. It gets a little more volatile as you go farther out. So we're here at about 5.8, call it 6% volatility, standard deviation, average, where they're over twice that, the New York Stock Exchange is. We're less than half, they're twice as much, but we only have half invested in stocks. These are times where we did better than them. And these are times where we didn't do as much. So most of the time we underperformed the New York Stock Exchange because we have half in bonds. But there were times where we did a lot better because we're defensive. Long term, we don't expect to do as much. Now remember, standard deviation for 3 years, ours is 8, theirs is 18 average volatility. Standard deviation for 10 years, ours is 6, theirs is 13. Twice as much. Okay, I'm willing to take less volatility and probably get less return in the long term. And we have the mean return, we have a 6.46. They only made 7.2, but let's say they reinvested dividends, probably about 9%. Still, we beat them, but only because we've had a lot of upsets in the markets in the last few years. Beta, remember that, 3 years, 5 years, 10 years, our 3-year beta is 0.45, or 45% as risky as the New York Stock Exchange. Over 10 years, we're 0.41 as risky. So if they drop 10, our hope is we're only going to drop 4.1. Not a guarantee, but we hope we have some insight and some feeling of that. The R square, we're only about 78.85%, similar to the overall stock market index and the bond market index. That's good because we have negative correlation. We're not 100% the same. So when the markets fall, it's hope that we're non-correlated. Gold is negatively correlated. T-bills are negatively correlated. Bitcoin is thought to be negatively correlated, meaning they might even go up when other things go down. We just want non-correlation here. Now, for somebody who's taking 41% of the risk, 0.41, that's the beta, how much better are we doing than other portfolios that take the same 0.41 risk? Meaning load funds, commission charge funds, high expense funds, horribly managed funds, funds that don't have managers that know what they're doing, funds whose managers don't do anything, even if they know what we're doing. We're doing 2.84% per year better than those horrible managed portfolios, those high cost managed portfolios, or other funds out there that are higher cost. So we improve our return by the base of the pyramid by having super, super low cost. And that brings our averages down for the mid and the top part. And by bringing the cost down, and if we do use managed funds, making sure they're the best of the best, then we end up having 2.84% per year better performance than the average. Now that's going backwards. That's not going forward. I can't guarantee anything. And even if I show this to a client, I have to remind them, you didn't own these allocations for the last 10 years. So I don't want to mislead you. I should never show you that and say, and you should invest with me. That's against the law. Can't do that. My industry, that's someplace where government does do a good job. Allocations, you can look at this later. High yielding is quite a lot, and there's no free lunch. If interest rates went up a lot and everybody's confident with the rest of the market, our high yield stocks could go down in value. They're not now, but it's a weird time. Our average price earnings ratios, 18.75. That's pretty good. The S&P 500s is up to high 20s. So if you want to buy stocks in funds that have relatively low price compared to the yield, you want a low price earnings ratio. However, if you want to buy Bitcoin and other blockchain technology, that's not even a part of the equation. Average bond ratings, 50% AAA, blah, blah, blah. Then some of these lower rated ones. If I get into anything below BBB, I want a managed fund. BBB could be an index fund and get low cost. You get the best of all worlds. Duration here, 2.88. So the funds in here on average will drop 2.88 if interest rates went up 1 full percent. But I don't think they've dropped that much. I've seen them drop 1.5 to 2%. That's just an emotional, I'm not going to sell my bonds just because interest rates went up on the short-term position. And you got to earn something. So we can't have zero duration, have money in cash, earn nothing for the next 10 years. We know that it will lose to inflation in a big way. If the bonds earn 2%, they might lose 5% a year instead of 7% to inflation. I'm just saying. Net expense ratio. This is on the high side. In the book, we talk about getting it down to 0.19, but this investor is ultra cautious, ultra conservative, and we had more more managed funds than we normally would like. So the expense ratio is 0.27, not bad, but the average gross ratio is 0.29. Well, the net is less because some of the funds lend out stocks, they make money, and they reduce their expense ratio temporarily going forward. If you have a portfolio and you have just Apple in it at all these brokerage houses, they can lend your Apple stock out, make money off your stock, and keep that rent for themselves. They just have to guarantee you that you have Apple stock. And if anything happened or you needed to sell, you could get your Apple stock back. Your exchange traded funds do the same thing, but they credit the expense ratio by the amount of rent they just earn by lending out your stock. It's not a risk that you're going to lose the stock, but I'm just saying, yes, these big brokerage houses will let you trade exchange traded funds for free because they get a spread also on stocks. Yes, they'll let you build up a big stock in your portfolio because they can secretly, legally, they have to disclose it, lend it out, make money off it for themselves. Just make sure at the end of the day, you have Apple stock or whatever they're lending out. So that's a quick view of the portfolio. I've been looking at this portfolio through Morningstar for probably 20 years now. And I learn something new every time I look at it, or I listen to the news, and then I get an aha moment. If you love this stuff, you could spend all day sitting at Starbucks, use their Wi-Fi, and listening to YouTube videos, okay, or other coffee shops. Use their Wi-Fi, bring your headset, and watch YouTube videos on beta. What is alpha? What is this? What is that? You can spend the whole day reviewing everything we're working here. What I've done is give you a process of section 1, financial planning reviews, diagnostics that don't take forever, and you don't have to spend $2,000 on a plan for. The second part of the portfolio, we're teaching you how to select the funds and creating a portfolio that works for you. And then the third part, we'll talk about how to monitor and maintain the selected funds, the portfolios, the estate plan, and the financial plan briefly. So what I've got is a game plan here, but you could look at YouTube, not take everything literally, don't trade from what you've learned, but educate yourself. There's a ton of people like me teaching classes there. We're uploading this class to my website. We've got 2 of the 6 up already, and I can't just automatically do it because the legal department has to watch it and make sure that I didn't mislead anybody or make any mistakes that they themselves will be liable for in addition to me. That's another thing. When you have your brokerage account at a big brokerage company, they're liable for the technology, but if you make some bad choices, you're liable, and they don't have to insure that. If you go through an advisor and he or she goes off the reservation on allocating the funds, they could be held liable for that. So everything I do, every investment I make, I have to justify based on the conversation with the client, and in the classes that I do have to be reviewed by legal. So you can go there if you want to go through it again. We have one more class. We'll review this. No one class will be the same. I'll go off on a tangent, which is helpful if you've already been here. So I thank you for attending. The next class starts on page 180. And I hope this has been very helpful. If you have any questions, you can text me after the class. You can check in, and if you want me to look at your portfolio that you've created, great. If you want assistance going forward, great. But it's up to you for what your needs are. So we want to educate you first before you decide to keep doing it or start doing it on your own, or hire an advisor or let a family member do that. So good luck until next week. There is a test at the back of the book. I'm not going to make you take it online, but at the end of next week, you should be able to take that test and pass it, right? So anyway, I'm going to stop sharing and come out of the class. Were there any last minute questions? Speak now, or for 1 week, hold your peace. Okay, take care. See you guys next week. It was fun.